So let us start our class. I just welcome you to today's class. I just want to do the questions of mergers and acquisition. Today we do May 2021 question 4, a question of mergers and acquisition here. I don't know who is ready to read for us today. A gentleman will be much good to hear from him. So it is good to hear from one of our guys. Yusuf, can you read for us today? Can you unmute and read for our question? Tabitha Wanjiru, can you read our question? Victor, good evening.
Evening.
Good evening to you, sir.
Mtu mmoja atusomee swali tafadhali, so that we move quickly.
All right, question 4B, right?
4B, yes.
I'll read. APCO Limited is considering to acquire Alpha Limited. The following are the financial data for the two companies. We have APCO Limited and Alpha Limited. We have net sales, profit after tax, number of outstanding ordinary shares, earnings per share, dividends per share, total market capitalization. Required, determine the pre-merger market value per share for both companies. Number 2, determine the post-merger EPS, market price per share, and price earnings ratio. Number 3, compare APCO Limited's EPS, assuming Alpha Limited's shareholders are offered 100,000 shillings, 5% convertible debentures for each share held in Alpha Limited. Assume a corporation tax of 30%.
Very good. I could see the examiner is giving you good questions here. Questions which is totaling around 7 marks. And we can see that 7 marks as being small marks, but they can make a very big difference at your level. So in this aspect, because the examiner is asking you about pre-merger, MPS, right? Let us go back to our board and be able to determine how can we be able to get the pre-merger. So this is how you normally get the pre-merger. Now, in this aspect, because the examiner is asking you to calculate the pre-merger market price per share, it means I have to be taking the capitalization, market capitalization, market capitalization, then you divide by the number of ordinary shares. So when you are being told about the pre-merger, it is before the merging. And in this case, it means I have to be calculating the pre-merger for AFCO, or is it AFCO? Yes, it is normally called APCO Limited. And also you need to be doing the market price per share for Alpha Limited. So let us look based on our question, what is being provided here. And when I look on that question, I could see the total market capitalization given, right, for each company, the total capitalization rate. So for APCO, it is 420,000, right? For Alpha, I can see you are being given 45,000. 45,000 there. When you talk about the number of ordinary shares, the examiner has already told us the number of outstanding ordinary shares for APCO is 7,500. So for the other guy, which is Alpha, the examiner has already given you 1,500. So what is the market price per share for each company before the merger? How much is this? So I just take out my calculator. I just say, so let me just take 420,000. You divide by 7,500. which I get 56 shillings per share. So in this case here, you're going to be getting 56 Kenya shillings per share, right? Then on the other side here, I just say 45,000 divided by 1,500. I'm getting 30 shillings per share. 30 shillings per share. 30 shillings per share. Now, number two, I can see the examiner is asking you to determine, right, post. The examiner is asking you to calculate the post-merger EPS. Calculate the post-merger EPS, right? He has also talked about the computation of post-merger market price per share and P ratio. And P ratio. So in this case, it means the first thing that I'm supposed to be computing here is to get the combined earning price per share. To get the combined earning price per share. And in this case, I just say, if I want to get the combined earning per share, right, let us take the combined profit after tax, right? Then you divide by the combined number of ordinary shares. The combined number of ordinary shares. The combined number of ordinary shares. Now, let us start by looking on the combined earnings of ours. Combined earnings as per the question for both companies. So for Alpha, or for APCO, sorry, the profit after tax given is 18,130 plus, when I look for Alpha Limited, the examiner has given us that 750. So how much it is? I just say 18,130 plus that 750. I'm getting 21,880. I just want to look on the combined number of ordinary shares. The combined number of ordinary shares. When I look at it, you just need to be taking 7,500 plus 1,500, which is equivalent to 9,000. Which is equivalent to 9,000. And in this case, if we are looking on a combined, when I look on the combined earning per share, I just need to be taking 21,880, you divide by my 9,000 here. So how much is the combined EPS? So I divide by 9,000. And I'm going to be getting Kenya shillings 2.43 per share. 2.43 per share. That is how you normally do it. That is how you normally do it, right? Now, I just want us now to be computing our combined market price per share, right? The combined market price per share. Remember, we are talking about post-merger. And in this case, to get the combined market price per share, let us look on the combined value. We're going to be taking the combined value of the firm. You divide by the combined number of shares, which are supposed to be ordinary number of shares, and ordinary shares, number of ordinary shares, sorry. So let us look on the combined value as per the questions given by the examiner there. And when we look on the combined value, to look on our combined value, I just need to be taking the market capitalization for APCO, which is 420,000, plus the Alpha Limited, which is 45,000. This is equivalent to how much? So 420 plus 45, getting 465,000. 465,000, right? So in this case, to get my combined, because I have the combined number of ordinary shares, I just need to come here and I say, let me take 465,000, you divide by 9,000. So how much am I getting there? So I divide by 9 here, and I'm going to be getting Kenya shillings equivalent to 52 shillings per share. 52 shillings per share. That is okay. Now, in this case, we are looking on the combined, right? Combined P ratio. And to get the combined PE ratio for both companies, get our combined PE ratio, just say, let us take the combined market price per share, right? Is it market price per share? It should be the market price per share. You divide by the combined earning per share. And in this case, when you look at the market price per share of ours, the market price per share, we were able to get how much? The combined market price per share, which we have already gotten 52 shillings per share, right? 52. You divide by the earning per share, which is combined. The earning per share, which we have already gotten 2.43. 2.43. 2.43. How much are we getting? So in this case, I just divide my answer, which is on my calculator, by 2.43. And I'm getting 21.3. 21.3 times. 21.3 times. 21.3 times. I think even when you see the approach of the question, nothing is hard there. Now, in this case, when I look on part 3, which is examiner is arguing a lot there, we're saying compare Upco's limited earning per share, assuming that Alpha Limited, right, shareholders are offered 100,000 shillings, 5% convertible debenture for each share held in Alpha Limited. And in this case, you know very well that the examiner wants you to calculate, the earning per share. So we are going to be repeating our simple formula, right? The simplest formula that we are just talking about, looking on the combined earnings, where we are going to be looking the combined earning per share, combined earning per share, where we are going to be taking combined earnings. We are going to be taking our combined earnings, then you divide by the combined ordinary shares. So in this case, let us look on what is happening here. When you look on our combined earnings, remember, when you look on your combined earnings, right, we were able to get 21,000. It is somewhere, even it is here, which is 21,880. 21,880. Now, let us less after tax interest, because already we just need to be getting the combined net earnings. And in this case, because already there is tax, where it is the tax, because after the tax interest is because you can see there is a 5%, 100,000 convertible debenture. So it is just like you are subtracting the interest on loan. So less tax interest, less our interest here. And in this case, we are being told, it is very simple. The examiner is talking about offering, it is saying that for every share held in Alpha Limited, so how many shares do we have? So you just say, if one share is offered 100,000, what about 1,500 shares? 1,500 shares. So how many shares, how much are we going to be having? Because there is a compensation which is going to be done there. And in this case, I just need to be saying 1,500 divided by 1. Then I multiply by 100,000, right? I think that will be okay. Then you multiply by 5% to get the interest. You multiply by 5%, right? You multiply by 5%. Then you adjust for your tax. So in this case, because we want to get the net of tax, I just multiply by 1 minus 0.3. 1 minus 0.3, because I just want to get the net of tax. And in this case, you remember that you have to be doing your computation from here. So it will be 1,500 times 100,000. Then you multiply by 0.05. Then you multiply by 0.7, right? We are going to be getting 50,000. 50,000. 52,50,000. Now, when you look on the combined net earnings, then that is why you normally you are being told, or you are normally cautioned, every time you are going to be doing your merger, it does not mean that in the first instance it's going to be making a profit. Let us look on the scenarios of this combined merger, and what you are going to be getting here, it is normally called the combined net earnings. Combined net earnings. The combined net earnings, when you take the 21,880 minus 52,50, how much are we getting? So 21,880 minus our answer, we are going to be getting negative, right? We're going to be getting 52,28, 120, which is negative there. Now, you remember very well, when we are discussing about the combined number of ordinary shares, because already we have converted our shares in the Alpha Limited into this with this debenture, giving us the combined net earning, which is negative. So when I just want to look on the ordinary shares remaining in the company, we are going to be looking on the parent company, where the number of ordinary shares remaining is for 7,500 ordinary shares. So let us get the combined earning per share. So in this case, it means we have to be taking 52,28, 120. Then you divide by the number of ordinary shares that you are holding within the organization, which is 7,500. And remember, this one is negative. So the earnings per share for both companies will be negative, right? Will be negative, and this will be equivalent to negative 697.08. Negative 697.08. Negative 6.7.08. And this is in Kenya shillings, right? So the combined earning per share, right, for this company is going to be negative. It's going to be negative 697.08. Any question up to that point? Any question to that point? Any question? Now, if we don't have any question, we can proceed to our next question, right? The next question is similar to what we were doing yesterday. So this question was tested on May 2016. Let us look on May 2016, what was happening there. May 2016. May 2016, we have question there. May 2016, question 4B. May 2016, question 4B. So let us go there. Who is reading for us today? Let's look for Cecilia. Cecilia, are you in?
Yes.
Good. So let us go to 2016 May. So that I just want yourself to familiarize with this question. Even I will be able to share the solutions for the last two sittings, for you to do a thorough revision as you march on. It should be question number 4B. So that I just want, when you open your past paper, you see familiar questions. So the question is for Huge Limited. You can proceed.
Huge Limited intends to take over Tiny Limited, another company in the same industry. Tiny Limited is expected to post earnings of 86 million shillings next year. We have year of acquisition, year 1, 2, and 3. We have sales, cash costs, stock expenses, capital allowance, interest charges, cash to replace assets and finance growth. From year 4 onwards, it is expected that the annual cash flows from Tiny Limited will increase by 4% each year in perpetuity. Tax is payable at the rate of 30%, and this tax is paid in the same year the profits to which it relates are earned. If Huge Limited acquires Tiny Limited, it estimates that the gearing after acquisition will be 35%, measured as the value of debt as a proportion of the total equity and the debt. After the acquisition of Tiny Limited, Huge Limited would have a cost of debt of 7.4% before tax and a beta of 1.6. The risk-free rate is 6%, and the return on the market portfolio is 11%. Required. 1. The offer price for Tiny Limited, if Huge Limited were to value Tiny Limited on a forward price earnings multiple of 8 times. 2. The weighted average cost of capital for Huge Limited after the acquisition of Tiny Limited. 3. The offer price for Tiny Limited using a discounted cash flow based valuation.
Now, in this aspect, we are just focusing our attentions to the calculation of the overprice. We shall be able to do it, the overprice, and the discounted cash flow. You know that best valuation, it is the one that I taught you yesterday. It is not something that is hard. The weighted average cost of capital for Huge Limited, you remember, when you look on it, the Huge Limited is the one that is acquiring. It is the Huge Limited is our predator, which is going to be taking over the Tiny Limited. Now, in these aspects, remember, we just need to be able to understand that when the examiner is asking us to calculate the overprice, he's giving us a free mark. Because we have been told to calculate the overprice, which we normally get it by taking the PE ratio, you multiply by the earnings, which basically they are profit after taxes. That is a direct question. Because already the PE ratio is given there 8 times. The weighted average cost of capital, which we know very well, we normally take the weight of equity, cost of equity, plus weight of debt, cost of debt, and then we adjust for taxes. Now, the calculation, because the weights already are given here, we are being told it estimates that the gearing after the acquisition is at 5%, measured as the value of debt. So if 35% is the value of debt, it means the value of equity is 65%. So when you convert to percentages, it becomes your weights. And so it means the weight of equity is 0.65, whereas the weight of debt is 0.35. That is very key. That is where we are being told after the acquisition of Tiny Limited, Huge Limited would have a cost of debt of 7.4% before tax, and beta is 1.60. So the aspect of giving me the beta of equity is because the examiner wants me to get the cost of equity using the CAPEM formula, where you have to be basing your argument that to get the cost of equity, I have to be taking the risk-free rate of return plus the expected return of the market minus the risk-free rate of return. Then we multiply by the beta coefficient. So that is one of the key things in which we have to be mastering here. So when I go to number 3, I just want to explain so that you see how easy it is. When you go to part 3, we have been told the overprice for Tiny Limited using the discounted cash flow based valuation. And when I look on my question hub here, the examiner has told us that from the year 4 onwards, it is expected that the annual cash flows from Tiny Limited will increase by 4% each year into perpetuity. And it means that the proportion or the growth rate after 4 years, it will be 4%. And it means the discounting factor that is going to be used between year 1 to year 4, we are going to be using the WSEC. The WSEC proposition that you're going to be calculating and getting. And it means after the stabilizing point, so it means the concept of the supernormal growth firm, where we say that to get the intrinsic value of a firm, you have to be combining, right? You need just to be combining the the present value of D1 up to the stabilizing point. That is one that we are going to be getting. Then we normally get the present value of P1 after the stabilizing point. In this aspect, it means I have to be focusing my attention in the calculation of the net cash flows. So because when I see on this question, the examiner has already given you the sales, we have the expended capital allowance, the interest, and the cash to replace assets and finance growth. So those are things that we have to be basing our argument and looking on how they are most applicable. Now, I just want to be able to check on the question here straight away by going back to a board, and we see how proper how we can be able to handle it in a proper way. Now, when I look on my question there, when I look on that question, the first thing that the examiner is asking before I continue talking much, it is the offer price. Right? Now, I have told you to calculate the offer price, you just need to be taking the PE ratio, very simple, PE ratio, we multiply by earnings. Right? Let me write it well. We multiply by earnings. So in this case, it means it is our profit after tax. It is our profit after tax. And in this case, as per the requirement we have been told, our P ratio is 8. The earnings per the total earnings, this should be the total earnings, sorry. Should be our total earnings as per the question. So the total earnings given by this examiner ni ngapi? The total earnings given. So can we be able to see what is our total earnings? So we have been told the post earnings of 86 million are expected in the next year. So I multiply here by 86 million. So how much am I getting here? How much am I getting? How much is this? So I just take 86 million, right? 86 million, I multiply by 8, getting Kenya shillings 688 million. 688 million. Number 2, right? Number 2, examiner is asking you a very simple question. Can you be able to calculate the WSCC? And I will be able to tell you, examiner, it is very simple. Since I'm going to be taking the weight of equity, cost of equity, plus weight of debt, cost of debt, and then I adjust for tax, right? But I tell the examiner, since the weights are given there, examiner has already given us the weight for debt, which is 0.35. Then it means the weight for equity is 0.65, because the proportion should be equivalent to 1. The proportion should be equating to 1. What about the cost of equity? I say I have many ways of killing this bird. Since I can take the risk-free rate of return plus the expected return of the market minus the risk-free rate of return, then I multiply by the beta coefficient. What is our risk-free rate of return as per the question? Examiner has given you 6, right? So I just say I take 6 plus the expected return of the market, which we have been given 11 minus 6. Then we multiply by our beta coefficient. Examiner has given us 1.60. So how much is this? So this minus this, I get 5, right? Times 1.60. Then we add 6, getting 14%. So to calculate the weighted average cost of capital, remember we said the cost of debt we normally take the risk-free rate of return. The risk-free rate of return. Now, when you look at it, right? When you look at it, we have been told that this is the time when it is not given. By the way, like yesterday, when I look on our question here, we have been told that after the acquisition of Tiny Limited, UG Limited would have a cost of debt of 7.4% before tax. So already the examiner has given us the cost of debt is 7.4%. But when it is not given, you know what we're supposed to be doing now. So the weight of equity is 0.65 times the cost, which is 14%. Then the weight is 0.35 times 0.074. Then we adjust for taxes. So it will be 0.35 times 0.074, right? Times 0.7, which is 1 minus 0.3, right? Then we add, open your brackets, you say 0.65 times 14, close your brackets. And you're going to be getting 9.11. Is it okay? This should be okay. Let me repeat again. I don't know why I'm not getting the same answer. 0.074 times 0.7 times 0.35 plus, I have opened my brackets, 0.65 times 14. I've closed my brackets. I'm getting 9.12%. 9.12%. 1.12%. 1.12%. So in this case, just ask yourself, how am I going to be getting the part 3 now? Because I know the discounted rate of mine, right? I know my discounted rate. Then I am supposed to be focusing my attention. I'm supposed to be focusing my attention in the computation of the net cash flows. The computation of the net cash flows. So how am I going to be getting this? Very simple again. Let us look at it. So in this case, I'm going to be calculating. I look on the number of years given by the examiner. So the years are in lump sum since the sales and the cost are not similar. So we have year 1, we have year 2, we have year 3. Let us start with sales. Because that examiner to pay Shidagani, we are able to maneuver. So our sales in this case, the examiner has given me, I can reduce my shillings to millions, right? Nobody can penalize you for that. So that I can just put there 200 shillings. The other one is 280, 320. 280, 320, right? Then from there, we less our expected cash costs. Less expected costs. Right? Our expected cash cost, the one is 120. We have 160. We have 180. Good. So then we let the interest on charges. So here also you factor your interest charges. So the interest charges given by the examiner, how much are we getting? The first one is 10. So it is all through 10 shillings, all through. So how much are we getting here? So 130, this is 70. How much is this 170? 280 minus 170. Getting 110. The other one is 320 minus 190, sorry. Getting 130. I will tell you very simple, less your tax. Less your tax at the rate of 30%. So I'll start with the last one, times, right, times 0.3. I'm getting 39 bob. Right? Then the other one, we are getting how much? It will be 30, 0.3 times 110, which is equivalent to that 3 shillings. And I see this one to be 21 shillings. Then we add our depreciation tax shields. We had our depreciation tax shields, right? Now in this aspect, when I look at it there, we have the cost of these the cost of each project for the first year. I can see we have 20, 30, and 40. So it will be equivalent to, right? Let me see. Because we are being told it is per year. So it will be, the first one will be 20,000 minus 0. You know how you normally calculate the depreciation tax shield. Then you multiply by 30%, right? So this one is equivalent to 6. So just put here 6. Then the second one will be, I just take the figure given, I multiply by 30%. So the second one will be 9, and then the last one will be 12. Because the number of years equates, because every year has its costs capital, or the capital allowance. Now from there, let us get the totals here. Right? How much for the first year? 70. Right? We have said 70. minus 21 minus 6, getting 43. The second one will be 110 minus 33 minus 9, getting 68. Then the last one will be 130 minus 39 minus 12, getting 79. Then there is only one thing that is remaining there. We have the cash to replace assets and finance growth. You subtract it and you say, let us less cash to replace, right? The cash to replace assets growth. So let me just write assets because already I have mentioned growth. So the first one will be 25, 30, 35. 25, 30, and 35. Get to your annual net cash flows. Imagine ukiwa umepita tu hii swali moja unapita exam. So you have 79 minus 35, getting 44. The second one is 38. Then the third one is 43 minus 25, getting 18. Kuna mtu ananiambia jelewa up to that point? Anyone who have not understood up to that point? Who has not understood up to that point? There is only one mistake that we did, and no one is able to tell me. We are not supposed to be subtracting. We even said we add our depreciation taxes. We add our depreciation taxes. Sorry for that. So it means all these answers of ours are wrong. So let me start with the first one, 70 minus 21 plus 6, 55. The second one will be 110 minus 33 plus 9, getting 86. Then the last one will be 130 minus 39 plus 12, getting 103. Minus 35, getting 68 here. How much are we getting here? I can see this is 56. Then the last one, the first one should be 30. 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 Now from there, let us proceed by doing our discounting cash, because the examiner is telling you to use the discounted cash flow. Now in this case, in this scenario, right, we just need to be saying, because already you have your net cash flows, we are being told by the examiner that the growth rate is going to be stabilizing for the fourth year. So in this case, this is what you do. Let me just start by doing it here, so that I avoid explaining too much. So just take your years, right? We have your cash flows. Take your discount factor that you calculated at 9.12%. Take your present value, right? So we have 3 years, 2 and 3, right? So in this case, our cash flow, we have 30, we have 56, and then we have 68. So we know the formula that you're going to be using here is for lump sum, 1 plus r raised to power negative n. So in this case, we say it is 1.0912 you raised to power negative 1, getting 0.9164. Let us go to second here. 0.83, right? 8398. Let us go to the third year. We are getting 0.7696. Multiply with your cash flows times 68. We are getting 52.34. The other one will be 0.8398. Then you multiply by 56, getting 47.02, 47.03 rather. Then we have 0.9164 times 30. What you are getting is 27.49. What is the total? Remember, you are getting the present value of D1 up to the stabilizing point. up to the stabilizing point. So 27 plus 47.03 plus 52.34. We are getting 126, 126.86. 126.86 there. From there, let us proceed by doing the present value of D1, right? The present value of D1 after the stabilization point. So in this case, we are doing the P1, the present value of PO after the stabilizing point. And we said the growth rate for stabilization, we say the formula to use, we say to get our PO, we take DO, 1 plus G, divided by KE minus what? Our growth rate. Our DO now is your current cash flow, which is 68, times our 1 plus our growth rate, which is now translating to 0.04. You divide by the cost of equity, which is 0.0912 minus 0.04, right? Then we multiply. How much are we discounting with it? 0.7696, right? You remember that is the thing that we were doing yesterday. That is how you discount it. So let us start by doing the denominator. So 0.0912 minus 0.04, right? Then the half there we take 1.04 times 68, divide by my answer. Then you multiply by 0.7696, right? Getting 1063.01. 1063.01. 1063.01. Now from there, let me check whether the answer is correct. How much are you getting? Eric, how much are you getting?
Excuse me, Malim.
Yes, yes.
According to the formula, there is no this 0.7696.
Yeah, according to this, there is no any formula. But when you take your discounting factor, remember what you are going to be getting is your current cash flow. You have to be discounting it. Even that is what I was doing yesterday. And I was multiplying with the present value interest factor. I was discussing about 4%, because that is what we are doing. Is it 4%? No, 9.12%, 3 years. That is what I was telling you yesterday. So once you get your PO now, it is today. So you have to be discounting it, right? Because that will be your cash flow now. You discount it to get the future value. Now, in this case, that is what I'm doing right now. I take 1.04 times 68. Then we divide by 0.0912 minus 0.04. You are getting 1381, by the way, 0.25. Then you multiply by the discounting factor, which now if you can do it, it is translating to 0.7696, right? Then you multiply just direct. I don't want you to be cramming a lot of things. And I'm getting 1063.01. So to get my intrinsic value, you take 1063.01 plus 126.86. Then I add 126.86. You are getting equivalent to 1190 Kenyan shillings. 1190 shillings. 1190 shillings. 1190 shillings. Any other question? Any other question? Victor, good evening.
Good evening to you, sir.
Is it okay?
Everything is okay.
Very good. Maureen, good evening.
Good evening.
Is the concept clear?
Yeah, it is.
Very good, very good. I know Yusuf. Yusuf, are you still here? I don't know whether Yusuf is still in our class for today. But now, let us concentrate by doing another illustration. November 2018. We do November 2018, question 4C. November 2018, question number 4C. I remember when I was doing my CPA, we used to like so much to read these questions because when I'm reading the question, I still understand what the question wants. I don't know why. We like to read the question so much. That is why I normally give you the opportunity to read. Because you are the person who is much concerned or in need of the question more than me. Because we just want to know how the concept and how the question is being done. So you are the person who should be reading the questions. So I'm not punishing you. Now, with reading for us, question 4C. And these questions are very familiar. Chilolo Industries. So someone to read for us.
Share.
Okay. Read.
You can't see the question.
Okay. Let me share the question with you. The question is here. Go on.
You see for Chilulu?
Yes.
Okay, and we read. Chilulu Industries Limited is considering acquisition of Roca Corporation Limited in a share for share exchange. The financial data for the two companies are given below. We have Chilulu Limited and Roca Limited. We have sales for each one of them. We have net earnings in millions, ordinary shares outstanding in millions, ordinary shares market price per share, dividends per share. Additional information. Chilulu Limited is not willing to incur an initial dilution in its earnings per share. Two, Chilulu Limited will have to offer a minimum of 25% of Roca Limited's current share market price. Required, the relevant offer price range. Number two, if Roca Limited's shareholders accept an offer by Chilulu Limited of shillings 40 per share in a share for share exchange, determine the post-merger earnings per share. Three, using the results obtained in C above, and assuming that Chilulu Limited's price earnings ratio will remain unchanged after the merger, determining the post-acquisition market price of a share of Chilulu Limited.
That's okay. Now I can see that we have to be determining who is a predator, who is the target. I can see Chilulu is trying to buy Roca Limited. There are some of the conditions which are being given there. We are being told Chilulu Limited is not willing to incur an initial dilution in its earning per share. But we are being told Chilulu Limited will have to offer a minimum of 25% of Roca Limited's current share market price. So number one, we are being asked to calculate the non-dilution over price of predator. And in this case, because we have been told to give a price range, that is what we are going to be calculating today, right? A price range. Now, in this scenario, because we have been told to be calculating it, the first aspect, if you are able to calculate the non-dilution over price of predator, it means I have to be getting the pre-merger PE ratio of predator. Then I multiply by pre-merger earning per share of the target. Now, from that formula that I've already read for you, it means if you can take the market price per share of the predator, you divide by the earning per share of the predator, and then you multiply by the earning per share of the target. We are going to be able to achieve our non-dilution over price that we have been given there. Now, from that aspect, it means that if I can be able to get non-dilution, then I will be able to look on the minimum, because already we have been told the minimum offer price should be 25%, but it should be 25% of what? We have been told the minimum accepted offer should be 25% of Roca Limited current share market price. And in the illustration part 2, under the requirement part 2, we have been told that if Roca Limited shareholders accept an offer by Chilulu of 40%, so how much is going to be equivalent to that? And equivalent to that is 10 shillings, by the way. The minimum offer price is 10 shillings. So the offer price range should be between 10 shillings and the dilution over price that I'm going to be calculating for you, right? So that is how the question is asked. So let us go back to my board and I'll be able to show you how the question is normally done. How the question is normally done. So we are discussing about non-dilution. Non-dilution of a price, which we normally get it by taking pre-merger P ratio, the pre-merger P ratio of the predator. We normally take the pre-merger P ratio of the predator. We multiply by the pre-merger EPS of the targets. So in this case, in simple terms, right? It means I'm going to be getting it by taking the market price per share of the predator. We divide by the earning price per share of the predator, right? Then we multiply by earning per share of the target. Let's put easy to very simply, in a very simple manner. Now, in this case, remember you are dealing with only 2 companies here. You are dealing with Chilulu Limited. You are dealing with Chilulu Limited here. And then we have, it is Roca Limited. Now, in this aspect, let us look on whether the examiner was able to give you the market price per share. And we say yes. The examiner was able to give us the market price per share, which is 50 and 40. And to get the earning per share for each company, we are going to be taking, right, the earning per share. Let us take the net earnings. You divide by number of shares. I assume you understand the number of ordinary shares. So in this case, let's start with Chilulu. Now I can be able to see the net earnings I've been given is 30 million. So I just take 30. I divide by 6 because the number of shares for Chilulu is 6. This translates to 5, right? Then for the other guy, right, how much will be 12, right? You divide by 2, which translates to 6, But we have been told very well there, right? We have been told, can we be able to get our non-dilution over price? Yes. Before we go to anything, non-dilution over price, which you are going to be taking the market price per share, which is equivalent to 50. So I just say it is 50. You divide by 5. 5, remember the Chilulu is the EPS of the predator. You are able to get at 5. Then you multiply by 6, which translates to Kenya shillings, 60. Right? Now, because we are being given, the examiner is asking us to calculate the range. Let us look on the minimum. Because we know this is the maximum, let us look on the minimum over price. The minimum over price. The examiner, in additional information too, is saying Chilulu Limited will have to offer a minimum of 25%. We multiply by how much the least they can be able to accept is 40%, which translates to Kenya shillings 10, right? And in this case, we can be able to say the offer price range. The offer price range is between Kenya shillings 10 and Kenya shilling 60. It is between that range, between 10 and 60. That is what we are looking at it there. We have 4 marks. We have 4 marks for doing that. We have 4 marks for doing that. Number 2, you can see examiner is asking you what? If Roca Limited, right, accept an offer by Chilulu Limited of 40 shillings per share in a share for share exchange, determine the post-merger earning per share, right? The first aspect that we have to be looking on such kind of a question, the first thing that we need to know or to determine is the maximum, right? It is normally called the maximum exchange ratio. So to get the maximum exchange ratio, get our maximum exchange ratio, we are going to be taking, right? We are going to be taking the offer price of the predator then you divide by the market price of the predator. The market price of the predator. That is the first ground. And in this case, you know, the offer price is 40 shillings. Given there, another additional information too. Then you divide by the market price of the predator. We are being given as 50. This translates to 0.8, if I'm not wrong. And I can say Chilulu Limited is offering Chilulu Limited is offering 0.8 of new shares. 0.8 of new shares. 0.8 of the new shares for every share. For every share of Roca Limited. That is what the first thing that we were supposed to be doing. So because the examiner is asking you to come up with a post-merger earning per share, it is going to, basically to be checking on coming up with the combined earning per share. The combined earning per share. Remember we said, let us take our combined earnings. We divide by the combined number of ordinary shares. So let us look on the combined earnings as per the question. Our combined earnings as per the question. We are being given the net earnings for Chilulu, which is 30, and for the Roca, which is 12. This translates as 42, right? That is 42 million Kenya shillings. Let us look on the combined number of ordinary shares. Combined number of ordinary shares, right? Remember already, you know the number of shares for Chilulu, which is 6 million, plus, remember one share of Roca, we are offering 0.8 shares. Right? You're offering like that. You ask yourself, what about the 2 million? Sorry, one share of Chilulu is equivalent to 0.8. You ask of Roca, what about the other one? Will be, how many shares do they have? 2. We discuss about 2 shares. Remember, they are in millions. So once you cross multiply, it will be 0K. No, it should be the other way around. Right? Let me interpret again. It should be 1 share of Roca is equivalent to 0.8 shares of Chilulu. What about the 2 shares of Roca? Because we are the people who are giving them offer. So in this case, it will be 2. It will be 2 times 0.8. 2, remember, they are the number of shares of Chilulu, of Roca, sorry. And 0.8 is what it is the maximum offer price that we are able to compute there. the maximum exchange ratio, because we have said Chilulu Limited is offering 0.8 of new shares for every share of Roca. So one share of Roca, we are offering 0.8. What about 2? How many shares, right? This is translate to 1.6 million shares. So just multiply here, add here 1.6 million. And it means the number of ordinary shares that we are looking here, when they are combined, is 7.6 million. Now, in this case, let us compute our combined EPS. I just take the combined earnings, 42 million, you divide by 7.6 million. How much am I getting? 42 million, I divide by 7.6 million. I'm getting 5.53. 5.53 per share. 5.53 per share. Now, part 3, we are being told, using the results obtained in C1 in 2 above, and assuming that Chilulu Limited PE ratio will remain unchanged after the merger, determine the post-acquisition market price of the shares of Chilulu Limited, right? And in this case, because we have already discussed about this, right? It is very simple. It is a very simple. That is why you see the examiner is offering you only 2 marks. The examiner is offering you only 2 marks there, because nothing much you are doing. Part 3. Examiner is just asking you to calculate your combined market price per share. The combined market price per share. And from the formula that you know for the PE ratio, the combined PE ratio, we said you normally take the combined market price per share, you divide by the combined earning per share. So if you make the combined market price per share the subject, then it means you are going to be having the combined PE ratio. We multiply by combined, all right, the combined earning per share like that. Now, in this case, just ask yourself, what is our PE ratio for Chilulu, right? And you can see, to get the PE ratio for Chilulu, this is 1 for Chilulu. Remember the market price, it is 50, right? Right? And then you know very well, as per the question there, the earning per share we are getting is 5. This translates to 10. That is your PE ratio, right? That should be combined, by the way. That should be combined. That should be combined. Because you know the 50, right? You know the 50. It is the market price per share for Chilulu. And the 5 we were able to compute under the illustration part 1, the earning per share for Chilulu was 5. So when you're looking on the combined PE ratio, right, we are going to be using for Chilulu. Because the Chilulu would be the predator. Then you ask yourself, what is our combined earning per share? And we were able to get it under the requirement 2, where we were able to get 5.53. So when you're looking on the combined market price per share, you just need to be taking the PE ratio of the predator, which is 10. Then you multiply by, and remember this is what we were able to do. Because we say to get the combined, you take the market price per share or the predator, you divide by the earning per share of the predator, we multiply by the EPS of the targets, right? But in this case now, because you're looking the combined market price per share, you just need to be taking the combined PE ratio of the predator, then you multiply by the combined EPS that you are able to get as 5.53. So when you multiply, the combined EPS will be equivalent to 55.3 per share. Per share. 55.3 per share. I just want to give assignments as I run away from this topic. I just want to give assignments. 1, I just want to do a question which they tested on May 2018, question 3C. Then we have another question which they tested on, right? Is it April 2022? Yes. April 22, there is a question there for the mergers and acquisition. For the mergers and acquisition. I know as you see me finalizing, more tension or students continue panicking now because you know you are close because see tunakopeana kwa classmate, right? Now, the other thing that we are going to be doing, and is our last thing, which I can't do it today, which I will be able to do next week, it is the international financial derivatives. Unajua, they don't miss. So also don't miss your classes. They will be the last classes that you're going to be having next week as I complete by showing you the simplest way of interpreting the international financial derivatives. You know very well that the most important aspect that you're going to be dealing with here, it is the money exchange, whereby you normally find that the companies are dealing with the overseas, or they are already dealing with the international transactions, and therefore it is important to be understanding how to operate the currencies. So in this case, we know we are going to be dealing with three things. I just want to do an introduction here. We are going to be working with looking on the forward contracts. What is a forward contract there? We are going to be looking on the money markets, or they are normally called future contracts. Then the other aspects here that you're going to be looking, they are called options, right? Options. And we also all normally have swaps, by the way, but those ones I shall be able to tell them as we move on. So the forward contracts, we have to be knowing, when am I going to be using the forward contracts? What are the roles of the bank as I continue to understand the aspects of the international financial derivatives? What is the money market, right? Because we are discussing about the future contract. What is the proportion, or what do I normally use to exchange when I'm working with this kind of forward contract? Sorry, how do I normally, what is the range? What is the role of the bank? How can I be able to identify where is home, where is the foreign, and so on? Those are the things that we are going to be finding them interesting, because already we know the three of them, they are mostly related to multilateral agreements that are normally entered into under the international trades. And in this case, you know that they are all three types of the international contracts that we are going to be using, because when we discuss about the forward contracts, we really understand that it basically involves the rights, but not an right and obligation to either to buy or sell a given number of assets to a foreign countries at a predetermined exchange rate. And that is what we are discussing about the forward contracts. When you go to the money market contracts, they are very interesting because we are dealing with them. It is basically similar to the forward contracts, but we are saying it normally differs in certain under money market. It normally differs since we are saying the trader is basically required to borrow from the financial institutions and invest during the contract period. So remember, that is the difference between the two. Here, you normally give an option to borrow, right? You're normally given an option to borrow and invest during the contract period. So when you look on our analysis, when we are going to be doing our illustrations, we are going to be finding it easy, right? To be understanding when to borrow, right? Because there are only two rules which are basically used here. And one is that the foreign boyfriend should be buying breakfast, not breakfast, but supper. Those are the things that I'm going to be teaching you so that you can be able to understand those concepts. I have not said someone should be looking for a foreign boyfriend. I have not said that. Now, but I'll be able to teach you the best ways to do that. Because nakumbuka, when you see the people with money or the foreigners, we normally like them to take us out, right? Or we like to see them taking us or buying supper. That is the aspect of ladies, but I have not said to you to do so. Now, we are going to be analyzing these concepts in a simpler way so that you can be able to understand them, and we do a lot of illustrations. Then later on, we shall be able to capture the concept of options. And you remember that the options are just the financial contracts that normally give the right, but not an obligation, right? To others to either sell, which when we talk about the sell, it is normally called the put option. Then when we talk about buy, it is normally called a call option to a given number of a given number of assets in future at a predetermined price, which is basically called the strike price or exercise prices. So I think that we shall be able to do. I remember that we are also scared by one of the key things, which we discuss about parity measures, which we shall be able to engage ourselves in. We're also going to be looking on the Black-Scholes model and Baumol models, which are basically falling under this topic. I think I have already analyzed what the overview of what we are going to be covering next week. Those are the things that we're going to be doing. And I think I will be pushing very much because these questions normally follow, or they are normally done together. So I will just be doing this one day, and then I will just be able to finalize with the options, parity measures, and the other two aspects. And then we finalize our syllabus. That I think it is good a plan. It is a good plan. In meantime, I just want you to continue doing your revisions as we work on achieving our target. Any question? If we don't have any other question, we can just stop at that point. Let us stop